Welcome to this video. Today we talk about how bank guarantees help or influence international trade. Understanding bank guarantees in the context of international trade. A guarantee issued by a bank is bank guarantee. In general, it is a demand guarantee. Demand guarantee is a guarantee payable on demand. So it's a commitment by the bank, the guarantor, on behalf of a client, the applicant, to pay a specified amount, a certain amount to a certain party. This party is called the beneficiary. Now this payment will be if the client fails to fulfill the contractual obligation. Now in a bank guarantee, there is no need to provide evidence of the other party failing to fulfill the contractual obligation. The requirement is only to provide a statement or a certificate that the party failed. The understanding is that the parties will act in good faith. This bank guarantee acts as a risk mitigation tool. It ensures performance and it gets payment when trust between the parties is limited or legal enforcement is difficult. Unlike a letter of credit, which facilitates payment for performance, bank guarantee facilitates payment for non-performance. Okay, how does the guarantee work? The process is that the applicant or a buyer requests the bank to issue a guarantee. Sometimes seller also requests to issue a bank guarantee. The bank assesses the applicant's creditworthiness as usual, issues the guarantee to the beneficiary. It also looks at who the beneficiary is, whether there is room for wrongful claim. If the applicant defaults, fails to deliver the goods or fail to pay, then the beneficiary can claim the guaranteed amount from the bank by presenting a statement that the party failed to pay, failed to perform. The bank pays the beneficiary and seeks reimbursement from the applicant. This is how the process works. Now, what are the key types of guarantees? The most popular used guarantee is a tender bond or a bid bond. It secures the bidder's commitment in the tender that they will present a performance guarantee and take up the bid offered. Payment guarantee is to ensure that the buyer pays the seller. Performance guarantee is to ensure that the seller delivers the goods or services. Advance payment guarantee is to protect the buyer if the seller fails to deliver even after getting the advance payment. These are the main types of guarantee. There are other types like customs bond, judicial bond, shipping guarantee, etc. Guarantees are always irrevocable. It can be cancelled only with the consent of the beneficiary. It is conditional in the sense that the proof of default as in the form of a statement or submission of a original copy of the guarantee or statement that the contract has been breached, something like that might be called for as a condition to trigger the payment. Otherwise, guarantees are unconditional. There is no condition outside the guarantee. Guarantees are independent because the bank's obligation is separate from underlying contract dispute. The claim that the party did not perform as per contract need not be in the form of evidence of failure but can be in the form of a certification or a statement. What are the advantages or disadvantages? For the seller, assurance of the buyer payment or compensation for non-performance. For the buyer, it is protection against the seller's failure for non-delivery. Banks do get some fees. The disadvantage is that fees has to be paid to the bank and sometimes collateral has to be given to the bank. Sometimes the guarantee drafting has to be very precisely done and that brings in the complexity and that may cause or prevent disputes and cause delay in the payment, sometimes denial because of the clauses. So the risk that the applicant must reimburse the bank is always there, so for which the applicant should be ready when entering into a guarantee as a requirement for a contract. Let us look at a case study. Now suppose in 2025 there is a protectionism which guarantee can help to overcome. There is a supply chain volatility or a Red Sea disruption which guarantees can help to manage, and there are e-guarantees which are coming into picture because of the smart contract capability of blockchain and other innovations in the trade area. Looking at a case study, suppose there is an Indonesian energy company which is contracting with a Danish manufacturer to supply 15 million worth of wind turbines for a renewable project in Indonesia, Java. Now the delivery from Copenhagen to Jakarta should happen by June, for example, and to secure this deal they are providing a payment guarantee. Also, one has to offer an advance payment guarantee if 5 million is made as a prepayment out of this large contract of 15 million. Who are the parties involved? The exporter is Vindkraft, importer is Energi Indonesia, who runs the wind farm. Freight forwarder is Nordic Asia, who manages the logistics. Danske Bank is acting on behalf of Vindkraft in Denmark, and Bank Mandiri is acting on behalf of the Energi Hijau in Indonesia, Java, Jakarta. Both the customs, Danish and Indonesian customs, are also there to ensure compliance. Now, how the contract will look like? The contract will say 10 wind turbines has to be sent. It should be as per IEC 61400 standard. 15 million is the cost of the contract, of which 5 million is payable in advance against an advance payment guarantee. 10 will be paid on delivery against a letter of credit, maybe, and the terms could be DAF, deliver at place. And after this DAP contract is agreed at for the Incoterm, guarantee will be sought. The payment guarantee is that Bank Mandiri will guarantee on behalf of Energi Hijau Indonesia to pay 10 million balance if Energi Hijau does not pay on due date. So there is no letter of credit, it's only a DAP term and open account agreement. Now advance payment guarantee will have to be issued by Danske Bank in favor of Energi Hijau Indonesia, saying they will repay the 5 million if a claim is made, provided they give evidence that it was not repaid by the party, that they failed to deliver nor to return the advance given. So this is the advance payment guarantee. So Danske Bank on behalf of the seller issues the advance payment guarantee, Bank Mandiri on behalf of the buyer issues the payment guarantee, and then these two guarantees secure the 15 million transaction, of which 5 million is paid in advance by the Indonesian party to the Denmark party. Both the guarantees are irrevocable, they are valid till July 25, and the claims say there is a proof of non-performance that is required in this specific situation. Now contract is signed, Bank Mandiri issues the payment guarantee, the goods are shipped by the Vindkraft, DAP terms, goods arrive at Jakarta, payment is cleared because both the guarantees require unused, both the guarantees expire unused. Why? If the payment is made by the party on time, guarantees will not be invoked because goods have also come. Now the challenge is there could be a delay in delivery. North Sea storms delays shipment. The DAP contract holds Vindkraft responsible till the goods are delivered at Jakarta. But Energi Hijau accepts the delay, not invoking the advance payment guarantee, no breach, just a delay. So they did not invoke the guarantee. Why? Because they know it is because of the force majeure and it is acceptable according to them. Now comes the payment risk. Energi Hijau's cash flow tightens due to local currency drop, IDR versus dollar. Bank Mandiri's payment guarantee ensures Vindkraft 10 million. They could have invoked at any point in time and it is valid till July. But Energi Hijau pays, though with a small delay, and so there is no claim on the guarantee. Then comes there is a dispute. There is a dispute. What is a dispute? The dispute is that the two turbines worth 3 million malfunction on arrival. Energi Hijau considers withholding 3 million, but the payment guarantee covers full 10 million post delivery, and a separate warranty claim resolves the issue outside the guarantee because the warranty claim will help them to get it repaired. Now the outcome is that Vindkraft nets 14.5 million because of 500,000 has been paid as a freight for a DAP shipment. 12 million is the cost of their manufacture. Energi Hijau pays 15.85 million on a 15 million contract. Why 0.85 extra? Because they have to pay for the import duties. Now there is a guarantee fee paid. Now payment guarantee assures Vindkraft of 10 million when the Denmark party supplies. This is critical in today's volatile Indonesian market. The advance payment guarantee protects Energi Hijau's 5 million because they have to build a trust with the new supplier. For this they pay banking fees of around 350,000. Now the insight is that the risk mitigation in the form of payment guarantee secures non-payment. The flexibility that the both the parties get cash upfront, one getting advance and another getting payment against shipment, that flexibility is there. And even though there is a small delay in payment, it is a payment balancing that is happening because liquidity is understood in a tariff heavy year. Then comes the independence. Guarantees focus on contract terms. They are independent from the capabilities of the parties themselves. So quality dispute, the funding liquidity etc. does not come into picture because of the independence nature of the guarantee. And then because of the blockchain and other capabilities, e-guarantees and blockchain and smart contracts could also be used to make things faster. This is how guarantees can be used in an international trade. Thanks for watching this video on understanding BGs on international trade. We shall meet upon another session.